God bless everybody. Today it is September 28th of 2023. This is a quick market watch update. A lot going on here. Fed decided to do that pause on the 20th, but it was a hawkish pause, and the markets have been reacting tremendously to that hawkish pause. He's indicating he's going to raise again. He's not going to have a choice because the bond rates keep melding up, as I've been talking about. Well, they did a massive spike in the last few days, and that's causing all kinds of problems with the mortgages and different things like that. And so we're going to watch this continue to meld up. Not only does that cause a lot of problems with your auto and your home and commercial loans and different things like that, because these bond rates are spiking, they're doing a lot of selling off in the foreign markets like the Japanese markets and things like that, and all those bonds are coming back home. That's causing additional inflation and moving those rates up more, and they just keep melding up. And if the Fed decides to raise rates or to keep them elevated for a longer period of time, that will also then move the bond rates up. And so you're just going to keep watching these bond rates move up, and this is going to affect everybody that has any kind of debt whatsoever: credit cards, auto loans, commercial loans, mortgages, different things like that. So, and it affects foreigners more than it actually affects us. Another thing that we should be watching is we have a government shutdown that is potentially going to happen in less than 3 days, and they are not close to a deal at this point. So this could actually happen. And if it does, that would actually then force a number of rating agencies to come in and downgrade the United States. And so you'd see an immediate downgrade, which then would send the markets into a real nightmare, I believe. But we'll see how that is, and maybe that is the black swan event that's coming up, that we would potentially see the markets start to melt down as the government shuts down, and they know that they're not going to be able to fix this anymore. The longer it lasts, and I'm a big one for government shutdown, that's fine. We don't spend money when we do that. They would bare bones and minimize everything to whatever's necessary to run under those conditions. And so we'll see if they actually do figure this out. But there's a fairly large divide right now. We'll see if they actually get it. You know what? They've been kicking this can down the road so long that they might just mess this one up. They could literally just botch this one completely, and we could see a default, a literal shutdown, all kinds of things happening here, and that would then start to create those downgrades in the credit agency, which also potentially would cause a weakening in the dollar. I'm not sure how that would actually work. We'll have to see how that moves forward. Usually when the dollar strength, as it has been moving up with so much strength, we're seeing it parity out against, let's say, the euro, but then when you go to the Japanese yen, it's like 150, and they're having to do curve controlling, which is basically, printing treasuries and things like we did. That seems like the key method is that when governments get into debt issues, they print treasuries. I believe Janet Yellen just printed about 1.5 trillion treasuries to be able to maintain us through this debt crisis. And if you look at this, I believe this is only going to kick the can down the road about November 17th, and then we will be in the same impasse again. So this isn't happening on like a yearly basis anymore, or even a quarterly basis. This is every month or every couple months we're having to go through this process. There is a point in time where they can't service the 33 trillion on the books, which is basically about 1.8 to 2 trillion a year, which is about half our GDP. So that's a problem for the government. Now, as you can see, there's been a massive drop in the Dow index, and I thought it was interesting because you get this 666 in the middle of it. I don't know if that means anything or not. Just interesting timing. You have seen a fairly large drop, probably looks to me like about 2,000 maybe over 2,000 points from top to bottom here. So I could probably go figure it out, but I'm just saying you've had a massive drop. I don't know if we're walking into a potential bear technical cycle of 10% or more decrease, because that would have to be approximately 3,400. So you're probably not in a technical recession or technical bear market on the Dow yet, but it's not looking very good. And I don't know on the charts. I haven't looked at it, so I don't know if it's fighting resistance or any support lines or not. But it is definitely dumped in the last week or so. Now, I've been talking about this bond meld up. This is huge because we've not seen this. This is historic movements. I mean, you've been in the banking or been the banking industry a long time. I'm telling you right now, these are historic moves to this point where most of the people in the industry that are giving your loans out have never seen anything quite like this before. And that's what I mean. Most of these guys don't know what they're talking about because they've never seen anything like this before. I've been around this industry for 40 years. I've been doing this a long time. I actually built some of the original mortgage loan systems. Mortgage rates hit a 23-year high, okay? That's because this bond, 2-year bond is melding up, and actually the 10 and the 30s are melding up faster than the 2-year bond, which makes the inversion less, but just more destructive, okay? So you need to understand that. These bond rates are moving up. They're actually spiking. And when Jay Powell came out, the Fed, the other day on the 20th, he spiked these bonds to levels that were unheard of, okay? This is forcing all your loans and everything to get more expensive. As we're watching what? Brent now hitting close to $96 a barrel. That's moving up towards $100. You have a geopolitical nightmare in the Middle East. You'll be talking about $150 a barrel, which you don't know what that would do to the pump price, okay? It's moving up now to $100 a barrel, and look at what the price has done in the last few weeks. Can you imagine if this goes to 125 or 150 because we're actually in a war, a real war? That would cause all kinds of issues out here for everyone. So as this article indicates, we're now at a 23-year high this week. That's huge, man. And we're working into those 70s where you're going to see double digits. And we had up to 18% rates, and that could even be worse than this one because I believe the liquidity of the money they've shoved into the system is so much greater than before. This is going to be a much more destructive cycle than we saw in the past. And look at that. So the rate went from a 7.1 to a 7.31, and back in 2000 when we had an economic recession, that was the Y2K crash, was at 7.24, so we're, or 7.42, so we're already pretty much at that rate already, and these bonds aren't done. They're going to meld up, and that's why he's going to potentially have to raise again, because the 2-year bond keeps climbing on him. I keep telling you that. He's following the 2-year bond, which is spiking right now. It's not at 5.5 where he's at, where he paused, but it could easily get there by the time they have another meeting at the end of October, first part of November in that next meeting. So we're watching not only the 10-year spike, but the 30-year spike up. 2 years moving up also, but the long end is moving up quicker, and that's causing everybody more problems out here because that's what your loans are based on, is either like a 7-year balloon or whatever, 15, 30, or whatever you've got on your homes. And so these rates are going to continue to move up. That's also going to then increase your car loans and your credit cards and other loans similar to that. So the banks borrow at this 2-year rate of this treasury, okay, or this bond. And that's at over 5 now, okay. But the 10 and the 30 had been almost down around 4. Well, they're melding up now, so there's less inversional gap, but everything's melding up at the same time. You can see since about May here, we've seen this massive spike in the bonds, which is actually a negative inverse on the chart. You can't tell because it's opposite. And then you go to this 10-year bond, you realize this is really spiked. I mean, these are affecting people tremendously when you're already on a short income. Look, you've got student loans coming due. You're walking into winter. You're going to have to start filling your fuel tanks for your houses. Fuel at the pumps moving up. Food inflation moving up with that. And everything's moving up with fuel moving up as you're reaching close to 3-digit barrel again, oil. And so all these things, all these factors are culminating into the perfect storm, which is we're moving into a depression. Okay, look, everybody, we've been in a technical recession for some time, over a year now. You're getting ready to walk into 2 additional prints of negative GDP for third and fourth quarter, while you've had a confidence rating falling, contraction in manufacturing, and all this stuff happening. And now you got a bond rate of 4.585, which is forcing all your loans to move up. And so when you get into these next charts, you realize that when you get into the 30-year chart, you're way over 8% now, and we could potentially be over 10 without even trying to before too long. Here's a chart of the 30-year fixed, at least based on average rates and different things like that. I know the other chart indicated it was something else, but I just normally go out, look at 30-year mortgage home rates. That's what they're literally charging you based on whatever it was that was in here. At this point, it's 300,000. A lot of average homes on the median are 400,000. So see, it does regulate some, but you're way over the 3 or 5% that people were normally getting at a bigger or local bank. And so you were getting like a 3.5 at a large bank, 5.5 at a regional bank. Now you're getting a 8.1 at a large bank. And so your regional banks have got to be, 8.5 or higher. So people just can't refinance these loans at a potential 5% higher rate than they were before on a $400,000 house is a lot of money. And so people are going to have to start handing the keys in to not only their auto, commercial, and their mortgages on their houses. Okay, so there's going to see a lot of defaults starting to happen. And I keep talking about Bitcoin dropping below 20,000 here for too long. I was talking about it around July, but then it reformed. They did some manipulation out here. It got really crazy. And you are now in a new head and shoulders pattern. This would be the first shoulder. This would be your head. This would be your second shoulder. If you take the gap between the top of this chart to the bottom of the shoulder, or what they call the neckline, that's about a 6,000 to 7,000 point gap difference. And so that's what I said. If you look at this, you could potentially drop under 20,000 on Bitcoin pretty easily. And that's not the third leg completely finished. That is just the first drop of that third leg. So this could get really rough on this chart here someday, but I just want you to realize that I know no financial advice here. I would not be investing in Bitcoin right now. I'm just saying, I think it's getting ready to go down. So the last thing that I wanted to bring to your attention I wanted to make this a fairly short video. Just realize there's a lot going on in the markets right now. This is not getting better, and we're getting into a really historic time of complete destruction in the bond market. And if they start selling off the foreign bonds and they start coming back, that's going to really change our dynamic over here a lot. So something really important. We're in the Feast of Tabernacles, and we just went through Feast of Trumpets and Yom Kippur on the 24th, which is the holiest day, or the Day of Atonement. We're in the Feast of Tabernacles. That runs from September 29th to October 6th, which I think is really important because on my chart, we have this gap between those 21 days between September 18th and October 9th that I keep talking about, and potential attack from Israel and Iran around October 9th or on that very specific day, based on my paradigm on my chart. That would lead us into a war with Turkey coming down into Syria and potentially siege on Israel and Jerusalem by December 22nd of 23 based on my charting, which would be the 10 of Tibet. And so I think that's extremely important as we're getting ready to watch Israel break out into a war with Iran at any time. But if you look at that prophecy of Daniel 10, it clearly states that Michael and Israel will go forward first, and then the king of Greece or Turkey would come in shortly after that. So I would be looking for a potential massive attack from Israel on or around October 9th. Shortly after that, Turkey would come in with a invasion on Syria, then would lead us to the December of 22nd of 23, which would be the 10 of Tibet, which would actually a sieging on Jerusalem itself. God bless. Have a great night. Find the open door. Find Jesus. God bless.